just a couple of observations is that there is a capex cycle going on that's raising GDP and government spending, but domestic ordinary businesses in the US are struggling because rates have been high. And so you've got this bifurcation, the domestic versus the internationals kind of thing, as you said. And that's caught a lot of people offsides as just misunderstanding that whole process, when in fact liquidity explains what between 90 and 97% of pretty much everything. You have one macro factor. I've always said that it's the greatest and easiest macro risk-taking environment of all time because you have one macro variable that matters and nothing else really counts.
The U.S. economy shows a clear divide. Domestic firms struggle with high rates while global companies thrive on capex growth. Liquidity remains the main market driver as central banks shift credit creation to private bank. AI is transforming crypto trading by tracking whale activity and predicting moves before they happen, giving traders a major edge. At the same time, automation and AI investment are rising fast, reshaping industries amid labor shortages and market volatility.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
It's always been my impression that the global central banks completely understand what they're doing. Japan is always the leader in this for some reason, because of its population's older, I guess. And there's signal in what they're doing, which is saying they've all seemed to have gone away from using traditional methods to just going straight to the private sector and using the banking system. And Japan is doing the same thing by readjusting its yield curve.
Yeah, it is. And at the same time, we're obviously seeing this global trends towards removing red tape, removing capital restrictions, etc., for private banks, again, incentivizing them to do the heavy lifting on this liquidity creation. And I think that's essentially what a lot of people have missed over the past couple of years, that we've seen a move from central banks doing the heavy lifting themselves to instead incentivizing the private system to do it instead.
Why did they do it?
At least my initial thesis was that, they were scared in the aftermath of that inflation spike in 2022 into asking someone else to do the dirty job.
They can't be hung for it. So it's like, well, we're not doing it.
Therefore, they've incentivized the private system to do it instead. And I think that makes, for as long as we're running inflation above their target range, that's probably how they're going to maneuver this.
Oh, so their messaging looks consistent. It's like, we're not adding liquidity because we understand inflation. Meanwhile, they're like, hey, you guys over there, buy as many of these bonds as possible and create more credit on the back of it.
The U.S. economy shows a divide between weak domestic growth and strong global activity, driven by rising capex and liquidity. Central banks now rely on private institutions to sustain liquidity across market. At the same time, AI is reshaping crypto trading by tracking whale behavior and predicting market shift. As automation expands, industries are adapting fast to labor shortages and volatility.
I wrote about this on X recently. I'm like, it's amazing because I went and searched via Grok or whatever to go and find any use of the word debasement by any media. There was none. Yep. And what's also incredible about the whole debasement trade, it was a bunch of fucking crypto people who figured it out well before everybody else. The gold people had kind of got confused with inflation because they were very stuck in the 70s idea. And it's the crypto people who figured this all out before everybody else. And finally, people are starting to realize that this is the thing. And so I think, as you say, it's still early because I still have to explain it to everybody. And by the time we even get to next cycle, I think it becomes the all-in, everybody knows what the game is.
Yeah, I think you're right. And we started out by discussing the business cycle and where we are in the business cycle. If you look at the best forward-looking evidence for labor, for example, temporary hiring. Of course, you do not hire people permanently when you think the outlook is slightly muddy still, which is, for sure still the base case at sea level. But we're starting to see, a mild acceleration in the temporary hiring while we don't see the hiring elsewhere. And that's the first clue of a reacceleration of the hiring cycle. So I think in a couple of quarters from now, we'll probably start talking about scarcity in various sectors again, and from an employment perspective, also given what's going on with the labor force, right? So my biggest bet actually right now is that the capex cycle that we see in data centers, AI, etc., will spill over to a massive capex cycle in automation. And those two themes are obviously interlinked.
The kind of robotics idea that everybody gets efficient in manufacturing.
Exactly. So look at it this way: if you see a decline in the foreign-born labor force as we do right now, and you send a lot of low-skilled workers home, if you're a farmer, if you're a warehouser, if you're in logistics, etc., you simply need to spend now to be on top of this. And ultimately, you're more into this than me. I don't think it's out of this world to think about a humanoid robot controlled via AR in India. So you can still hire, but not in the US. And I guess that's kind of what the administration is trying to incentivize early here. So I think it was really, really interesting when I did a study. And typically I hate looking, 5-10 decades back for comparisons, because nothing is kind of like that anymore. But I had a look at the last time we had tariffs implemented in size. And what happened in the aftermath of that was actually a huge capex cycle, because by implementing
the 50s.
Yeah, 50s, and then you had an implementation of tariffs just around the 1890s as well. So, you have a couple of empirical studies, and both led to capex, because you simply force the local manufacturers to do capex, even though they don't want to, especially if you shrink the labor force at the same time.
The global economy is entering a new phase where liquidity, automation, and AI are redefining both traditional markets and crypto. With central banks shifting responsibility to private institutions, and businesses investing heavily in capex and automation, we're seeing the groundwork for the next economic transformation. AI's role in predicting market movements and managing volatility adds another layer of innovation to this shift. As investors adapt, Bitcoin and broader crypto markets remain at the center of this evolution, where intelligence and timing are everything. What do you think? Will AI-driven strategies become the new standard for trading? And how do you see automation shaping the next wave of global growth?